Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CCH Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today feels a little unexpected. Usually when we're digging around in the microcap jungle on the NASDAQ, we're looking at two types of companies. You've got the biotech firm that's burning $3 million a month, hoping to cure something in like 10 years. Or you've got some AI startup with a cool website and absolutely zero revenue.
That is the standard menu for the microcap world, yes. High dreams, very low cash.
Right. But today, we are talking about soup, specifically chicken hot pot and fish head hot pot.
It is a distinct change of pace. We are looking at CCH Holdings, and to give you the headline, they're a Malaysia-based restaurant group.
Okay.
They operate primarily under two brands, Chicken Claypot House and Yuan.
Right.
And they just recently IPO'd on the NASDAQ back in October 2025.
And look, I'll be honest. When I saw fish head hot pot and NASDAQ microcap in the same sentence, my first instinct was to just, run for the hills.
I get that.
It sounds like a value trap waiting to happen. But then I opened the financials, and I actually had to, clean my glasses.
Because of the ink color.
Exactly. Black ink. They're actually making money.
It's the hook. It's the thing that grabs you with this one. In just a sea of unprofitable small caps, CCH Holdings is a complete anomaly.
So break it down. What are the numbers?
Let's look at the raw stats. We're talking about a market cap of around $96 million.
Okay.
Over the last 12 months, they generated $8.92 million in revenue. But the number that really matters is the bottom line.
And that is?
$0.91 million in net income.
So nearly $1 million in pure profit on, almost $9 million in sales.
That puts them at a net margin of roughly 10.2%. And we really need to pause on that number because it's huge for this industry.
Okay, contextualize that for me. Because if I'm a tech investor, 10% margins sound, kind of boring. But if I'm looking at a Chipotle or a standard restaurant chain, what are we usually seeing?
A typical full-service restaurant chain, they fight tooth and nail for a 3 to 5% net margin.
Wow.
If you're really, really efficient, maybe you hit 6%. CCH is doing nearly double that.
So how? How are they squeezing twice as much profit out of every dollar of soup sold compared to the industry average? Is that sustainable, or is that just some creative accounting?
It's not magic, it's structural. The research points to a hybrid business model.
Meaning?
They don't just own their restaurants, they franchise them.
The franchise model. The golden goose of the food industry.
Precisely. I mean, think about the economics. If CCH owns the restaurant, they pay the rent, they pay the waiters, they buy the chicken.
All the overhead.
All of it. But if they franchise it, the franchise pays for the build-out, the franchise takes on the lease, and they pay the staff. CCH just collects a licensing fee and a percentage of revenue.
That is pure margin expansion. You're basically stripping out all the operational cost and just keeping the brand equity.
Exactly. It creates this competitive moat through scalability, but without heavy capital intensity. They can open 10 stores without burning 10 stores worth of cash.
Okay, so the foundation is solid. They're profitable, which already puts them in, the top 1% of microcaps?
Easily.
But then we have to talk about the price tag. Because investors are not just handing them a trophy for being profitable, they are charging a serious premium for this stock.
They certainly are. The valuation is where things get a little sticky. They're trading at an EV to revenue multiple of about 10.8 times.
Oof. Okay, let's unpack that for anyone who isn't staring at a terminal all day. EV to revenue of 10.8? What does that mean in plain English?
Sure. Essentially, investors are paying nearly $11 today for every single dollar of sales the company makes.
Which is, it's unheard of for a food company. Usually a mature restaurant trades at maybe 2 or 3 times revenue.
Okay. Exactly. Maybe 4 if they're growing really fast. 10 times is what you pay for a software company that can scale infinitely at zero cost. You don't usually pay that for chicken soup.
So the market is pricing this as if it's going to grow like a tech stock, not a kitchen.
Yeah.
That implies a massive amount of optimism or, a massive bubble. Why? Why are investors willing to pay that?
They aren't paying for the hot pot in Penang. They're paying for the roadmap. They are betting that the $5 million they raised in the IPO is going to be used so effectively that the company looks completely different in 2 years.
And that brings us to the growth strategy, because when I read their aggressive roadmap, I felt like I was reading a movie script about an empire builder. It's ambitious.
It's a 3-prong strategy, and each prong gets riskier than the last.
Okay, let's start with the boring one, prong one.
Prong one is network expansion and consolidation. They're opening more spots in Malaysia, which is low risk. They know the market.
Sure.
But interestingly, they're also looking to acquire other Malaysia-based restaurant groups.
Just rolling up the local competition.
Exactly. It's a classic move. If you're a public company with access to capital, you buy up smaller private chains that can't grow. You immediately boost your top-line revenue, which helps justify that high valuation we were just talking about.
Okay, that makes sense. Standard playbook.
Yeah.
But then we get to prong two. And this is where I started scratching my head a little. They want to open a chicken Claypot house in New York City.
An international flagship.
Wait, hold on. New York City. The literal graveyard of ambitious restaurants. That sounds less like a strategy and more like an ego trip. Why burn cash on Manhattan rent when you're a microcap from Penang?
It does sound like hubris, doesn't it? We made it in Penang, now let's take Manhattan.
Right.
But you have to look at the geography of the money. Where's CCH listed?
On the NASDAQ.
In the U.S. Right. They need U.S. liquidity. If you're a fund manager in Connecticut or a retail trader in California, you're not flying to Malaysia to taste the chicken. The company is invisible to you. But if you have a bustling, trendy location in New York City that an analyst or investor can actually walk into,
It's a billboard.
it's a brick-and-mortar investor relations deck. The research suggests this isn't just about selling soup to New Yorkers, it's about selling the stock to Wall Street. It validates the brand.
That's a cynical, but probably very accurate way to look at it. It's a marketing expense masquerading as a restaurant. But the risk is huge. If that location flops, and plenty of great restaurants flop in New York, it's a very, very public failure.
High risk, high reward. If it works, the stock re-rates. If it fails, it's an expensive mistake. But frankly, the NYC plan is normal compared to prong 3.
Oh, right, prong 3. I honestly thought this was a typo in the filings when I first read it.
You mean the factory?
I mean the factory.
Yes.
In Africa.
Yes. They are building a manufacturing facility in Africa to produce instant noodles and sauces.
Okay, make it make sense for me. We have a Malaysian Hotpot chain listing on the NASDAQ, opening a flagship in New York, and now building a noodle factory in Africa. This sounds like they just threw darts at a map. Why on earth are they doing this?
It feels scattered until you look at the business model evolution. Selling Hotpot in a restaurant is a service business. It's labor-heavy, it's location-dependent.
Right, you can only serve as many people as you have seats.
Yeah.
It doesn't scale infinitely.
But selling instant noodles, that is consumer packaged goods. CPG.
CPG is the holy grail of scaling.
Exactly. You put a noodle in a bag, you can ship it anywhere. You don't need waiters. You don't need a lease on a building for every customer. They're targeting the local African market, which is growing rapidly, but they're also looking at it as a low-cost production hub to export packaged food to Europe and the U.S.
So they're trying to pivot from being just a restaurant chain to being a diversified food group.
Precisely. And that's a crucial distinction. CPG businesses typically command higher valuations than pure restaurant plays because the margins on volume can be just incredible. If they pull this off, they aren't just selling a meal, they're selling a product on a shelf.
That's fascinating. So a massive pivot. But it's also incredibly complex. You're talking about supply chains, export regulations, factory management. These are not the same skills as running a kitchen.
And that is the execution risk. We have to be the adults in the room here. This is not a risk-free trade.
Right.
Doing one of these things is hard. Doing both New York and an African factory while running a public company for the first time, that is incredibly difficult.
And how are they paying for all of this? Because $5 million from an IPO isn't exactly a war chest. Are they going to dilute us to death?
That's the critical point for shareholders. Management has explicitly stated that these plans, the acquisitions, NYC, the factory, are funded through existing cash and the IPO proceeds.
So no new stock offerings.
They're saying they are not planning immediate dilution or taking on heavy debt to do this.
That's huge.
Yeah.
Usually when a microcap announces a factory and a global expansion, the next sentence is, and we're issuing 10 million new shares to pay for it.
Exactly. They're trying to fund growth from the balance sheet. It suggests they're confident in their cash flow.
Okay, let's pivot to the market side. The stock itself, we're recording this in early February 2026. The stock has been public for, what, about 4 months? How is it trading?
So the IPO priced at $4 back in October. Right now, looking at the data from the last few days, CCH has been popping up on the most active and consumer discretionary movers lists.
Which usually means volume is spiking.
It does. We're seeing elevated trading volume and volatility. The stock is waking up. It's also important to note that the consumer discretionary sector as a whole is moving right now. CCH seems to be drafting behind that momentum.
But we have to talk about the liquidity risk, because this is something new investors often get burned on.
Absolutely. CCH has only about 1.3 million shares outstanding.
1.3 million, that is tiny.
It's extremely thin. I mean, imagine a very small swimming pool. If you jump in, the water level rises. If you jump out, it drops.
Right.
That's the stock. If a big seller, a whale, decides to dump 10,000 shares, the price could crater instantly because there just aren't enough buyers to absorb it.
So you can get trapped. You might see a price on the screen, but you can't actually sell your shares at that price because there's no one on the other side.
Exactly. It's volatility city. A single earnings miss could cause a sharp drawdown, and you might find it hard to sell your shares quickly without crushing the price even further.
And what about the insiders? October IPO means we are hitting that lockup expiration window right about now.
That's the next thing to watch. For listeners who don't know, a lockup is a period after the IPO, usually 90 or 180 days, where the founders and early investors are legally forbidden from selling their shares.
It stops them from dumping stock on retail investors right away.
Right. That period is likely ending or active right now. The market is watching nervously. If we see filings show up where insiders are selling, the stock will tank. But if they hold, or even better, if they buy more, that's a massive confidence signal.
So, we have the setup. Now let's look at the calendar. If I'm an investor looking at the next 3 months, February, March, April 2026, what are the catalysts I need to circle in red?
There are 3 main events. First and most immediate is the Q4 2025 earnings report. We expect that late February or early March.
First post-IPO report card.
Exactly. And it needs to be good. They have to show that revenue is actually growing and that those 10% margins are holding up. If they show a loss or shrinking revenue, that 10 times valuation will collapse.
Okay, so earnings is the first hurdle. What's number 2?
The NYC announcement. Right now it's a plan. Confirmation of a signed lease or an opening date in Q1 2026 would be a huge media event. It stops being a marketing idea and becomes a reality.
And the third?
Acquisitions. They said they want to buy Malaysian competitors. Closing the first deal in Q1 or Q2 would prove they can actually execute on that M&A strategy.
So let's synthesize this. We have a profitable company with a wild growth plan, trading at a premium valuation with very thin liquidity.
That pretty much sums it up.
If I'm listening to this and I want to play it, how do I do it? What's the smart wealth strategy here?
I'm giving CCH Holdings a bullish score of 7.2 out of 10.
7.2. That's fairly high for a microcap.
It is. It scores high on fundamentals. It's profitable. That's rare. It scores high on vision. The roadmap is clear, and it's funded by cash. It loses points on execution risk because the plan is so complex and on the lack of analyst coverage right now. But the risk-reward ratio is skewed to the upside.
So what's trade?
The time frame is a swing trade. You're looking at a 6 to 12-month hold leading into the NYC opening. You want to ride the anticipation. This is not a hold forever retirement stock. Not yet.
And position sizing? I assume small?
Very small. I can't stress this enough. 2 to 3% of your portfolio max. This is high risk, high reward. Do not put your mortgage on this.
And because of that volatility we discussed.
Dollar cost average, don't buy it all at once. Buy a third now, a third in 2 weeks, a third in a month. Just smooth out your entry price so you don't get unlucky on a volatile day.
And the exit plan. Everyone needs an exit plan before they buy.
Take profit at a 40 to 50% gain. If you get that pop on the NYC news, sell into the strength. Don't get greedy. On the downside, set a hard stop loss at 15 to 20% below your entry.
Be disciplined.
If they miss earnings or announce a major delay, get out. Do not hold the bag hoping it comes back. In microcaps, hope is not a strategy.
Smart advice. You know, it's funny. We spend so much time looking for the next AI breakthrough or the next electric vehicle stock. But sometimes smart wealth is just finding a company that sells good food, makes a profit, and has a crazy plan to sell noodles in Africa.
It really is. It's a profitable microcap taking a huge swing at global expansion, from Penang to New York to Africa. It's the kind of story that, if it works, becomes legendary, and if it doesn't, well, at least they didn't dilute you to do it.
That is the silver lining. Well, that's all we have time for today. A fascinating look at CCH Holdings.
Thanks for listening, everyone, and remember to do your own due diligence.
Thanks for joining Smart Wealth with Joshua. We'll see you in the next one.